Automatic Data Processing, ticker ADP on the NASDAQ, the company that processes payroll for 1 in 6 workers in the United States, across 1.1 million client organizations in 140 countries, with 49 consecutive annual dividend increases.
Founded in 1949 in Paterson, New Jersey. Headquartered in Roseland, New Jersey. 58,000 employees. Fiscal 2024 revenue of $19.2 billion. Client retention above 92%, the defining metric of a software business with genuine switching costs.
Henry Taub was 22 years old when he founded ADP in 1949 to process payroll manually for local New Jersey businesses. By 1961, ADP had gone public on the NYSE, one of the first companies to list itself as a technology company before the category formally existed.
In 1985, ADP launched the first payroll software for IBM PCs, beginning the digital transition from paper checks to computerized processing that would define the next 4 decades of the company's expansion.
In 2006, ADP spun off Broadridge Financial Solutions, separating its capital markets and investor communications business into a standalone company. The move sharpened ADP's focus on human capital management for employers.
In 2014, activist investor Bill Ackman launched a campaign demanding 3 board seats and a restructuring of ADP. 2 years later, ADP won the proxy fight. Shareholders voted with the existing board, reinforcing management's credibility with institutional investors.
In 2023, Maria Black became ADP's first female CEO in the company's 74-year history, ascending from a 28-year career inside ADP spanning sales, client service, and global operations leadership.
In 2024, ADP launched the ADP Assist AI platform, deploying AI-powered HR recommendations and workforce analytics to more than 100,000 client organizations across the ADP ecosystem.
ADP generated $19.2 billion in fiscal 2024 revenue. Employer Services, the core payroll and HCM software platform, accounts for 70% at $13.4 billion. PEO Solutions, the employer of record business, contributes the remaining 30% at $5.8 billion.
Employer Services revenue grew 6% year over year. PEO worksite employees passed 600,000, up 5%. Operating margin reached 24.5%, up 1.2 percentage points. Adjusted EPS of $9.20 grew 12%. Client retention held above 92%, industry-leading stickiness.
ADP's primary moat is a structural payroll processing monopoly. 40 million U.S. workers receive their paychecks through ADP's systems. That market position was built over 75 years of client relationships and compliance infrastructure that requires every competitor to first convince 1.1 million companies to migrate the most operationally critical software in their organization.
The compliance shield is the second moat. ADP processes 73 million tax filings per year across 140 countries, maintaining compliance with 45,000-plus tax code updates annually. Pure software competitors cannot replicate this regulatory depth without decades of investment in human domain expertise.
ADP has delivered 49 consecutive annual dividend increases, with an annual dividend of $5.60 and total annual dividends paid of $2.32 billion. The dividend history from $2.08 in 2015 to $5.60 in 2024 reflects a decade of compounding payout growth alongside earnings.
The dividend coverage is supported by free cash flow that consistently exceeds net income, a function of ADP's capital-light software model. With operating margins at 24.5% and client retention above 92%, the payout growth is backed by durable recurring revenue, not leverage.
On the competitive radar, ADP leads on compliance and tax filing depth at 95, reflecting the irreplaceable nature of 73 million annual tax filings. It scores 92 on both payroll market dominance and client retention. Intuit leads on AI and HCM innovation at 90, reflecting QuickBooks software-first positioning.
Paychex scores closest to ADP on client retention at 88 and compliance depth at 82, reflecting its similar small business payroll model. But ADP's international reach of 88 versus Paychex's 55 illustrates why multinational employers default to ADP when payroll crosses borders.
ADP operates in 140 countries, processing payroll for 40 million workers across 1.1 million client organizations. 73 million tax filings are processed annually. The PEO business employs 600,000 worksite employees. ADP Retirement Services supervises $600 billion in retirement assets.
The retirement assets create a lock-in that extends beyond the corporate relationship. $600 billion in individual employee retirement accounts tied to ADP's record-keeping platform persists through job changes, creating a personal financial relationship with millions of American workers independent of their employer's contract.
Maria Black holds a BS in Communications from Penn State and an MBA from Loyola University, Maryland. She joined ADP in 1995 in sales and client service leadership, beginning a 28-year tenure inside a single company before becoming CEO.
Black served as SVP and then EVP of Global Sales and Service from 2009 through 2023, overseeing the client-facing organization responsible for ADP's 92% plus retention rates. Her entire career was built inside ADP's sales and service infrastructure, which is the most operationally important part of the business. ADP processes payroll for 1 in every 6 workers in the United States. It touches more Americans' paychecks than any other company on earth, through a 75-year-old infrastructure that companies are deeply reluctant to migrate away from, regardless of how aggressively competitors price against it.
The ADP thesis is about compounding stickiness. Switching payroll providers is a 12 to 18-month IT project, and ADP's compliance infrastructure, which processes 73 million tax filings per year, creates an embedded regulatory moat that pure software competitors can't easily replicate in a single contract cycle. Welcome back to Charged Alpha. I am Hudson, joined as always by Lana, and today we are diving into the world's largest payroll processor, ADP.
Automatic data processing traces its roots to 1949, and Q3 fiscal 2026 just delivered a meaningful beat.
Stock popped 5.5% on the print after a rough year. Let's get into it.
Quick context, Hudson. ADP is the largest pure-play payroll and HCM provider in the world, headquartered in Roseland, New Jersey, with Maria Black at the helm since 2023.
Market cap sits at $84.6 billion. Shares trade at $2.10 and 15 cents, with a beta of 0.856, so it moves less than the market.
The dividend yields 3.2%, paying $6.80 per share annually. That's a notable income kicker on a defensive name.
And remember, ADP runs a June fiscal year, so Q3 fiscal 2026 maps to calendar Q1 of 2026, January through March.
Let us hit the headline numbers. Revenue came in at $5.94 billion, up 7% year over year, beating the $5.82 billion consensus by $120 million. That beat came despite the labor market softness that had investors cautious heading into the print.
Adjusted EPS landed at $3.37, ahead of the $3.29 estimate, and up 10% versus the prior year.
Adjusted EBIT margin expanded 80 basis points to 30.2%. That is the kind of operating leverage investors want to see in this name. The expansion came despite ongoing investment in Lyric HCM sales capacity, making the result even more impressive in the context of the broader spending environment.
Client funds interest revenue jumped 14% to $404 million, riding average balances of $48.3 billion.
That float income is the unsung hero. Higher rates and bigger balances together produce real recurring earnings power that most investors underweight in their models.
On the employer services side, retention hit a record Q3 high, even with pays per control essentially flat as the labor market freezes up on tariff uncertainty. Retention is the metric that matters most for long-term revenue visibility, and setting a quarterly record against this backdrop signals genuine franchise strength.
Zero pays per control growth is a real headwind. ADP usually gets a tailwind from clients adding workers, and that tailwind has stalled in this environment.
PEO revenue grew 7% with worksite employees around 752,000, so the co-employment business keeps compounding even as hiring freezes bite. The PEO segment carries higher client value because it includes benefits administration, workers' compensation, and compliance, making churn structurally lower than in standard employer services.
Management raised guidance calling for roughly 6% revenue growth and 9 to 10% adjusted EPS growth for fiscal 2026. Clean raise on a clean print.
Beat on revenue, beat on EPS, margin expansion, record retention, and raised guidance. By any scorecard, that is a strong quarter.
Let us talk valuation. ADP trades at 19.1 times trailing earnings, and on a forward basis, the forward EPS projection puts you at 17.3 times. That forward multiple prices in the raised guidance midpoint and assumes the labor market recovery shows up in pays per control before fiscal year end.
EV to EBITDA is 14.8 times. Not cheap in absolute terms, but well below where ADP traded at peak valuations in 2022 and 2023. That compression came as investors rotated out of high multiple defensives during the rate hiking cycle, and much of that derating may have overshot fair value for a business with this earnings quality.
Context matters here. This stock entered the Q3 print down about 22% year to date. A lot of bad news was already embedded in the price.
The 5.5% pop on earnings day reflects that setup. Sentiment was washed out, and the clean print gave the bulls something real to hold.
Sell-side coverage is mixed. 3 buys, 8 holds, 3 sells. Average price target sits at $274, implying roughly 30% upside from the current price. The hold camp is not negative on the franchise. They simply want to see pays per control turn positive before committing to the full recovery thesis with real conviction.
The hold-heavy consensus alongside 30% implied upside tells you analysts respect the franchise but are waiting for the labor market to cooperate before upgrading.
Price to book at 12.4 reflects the intangible value of the ADP brand, compliance infrastructure, and data network. Hard assets alone do not explain that multiple. $48 billion in client float is itself a balance sheet asset not captured in book value, generating over $400 million of nearly pure margin revenue every quarter.
For income-oriented investors, that 3.2% yield, combined with mid-single-digit revenue growth, is a competitive total return profile for a low-beta defensive name.
Now the why now. ADP just printed a beat and raise into a market that had largely given up on the name. That sentiment gap, combined with the stock being down 22% year-to-date coming in, is the real setup.
Client funds interest is up 14% and could keep working if rates stay elevated. Each quarter that passes without Fed cuts adds another $40 million in high-margin income.
Record Q3 retention in employer services is the leading indicator that matters most. Sticky clients mean durable recurring cash flows, even when new client growth moderates temporarily.
The AI story is finally tangible. ADP Assist now serves more than 100,000 clients, embedding generative AI into payroll workflows and creating a premium tier attach opportunity.
Lyric HCM is winning in mid-market. More than 80% of new mid-market clients chose Lyric this quarter, signaling real platform traction and potential share gains against Workday.
Beat, raise, AI traction, record retention. The investment thesis heading into this print was shaky. After the print, it looks substantially more intact than before.
Let us talk forward catalysts. The first is pays per control. Any inflection from zero back to positive employment growth would be a direct tailwind to the employer services revenue line. Each 1-point increase in pays per control historically adds $50 to $70 million in annual employer services revenue.
Second catalyst is the rate path. If the Fed holds rates steady longer than the market expects, ADP continues earning $400+ million per quarter on that client float.
Third is Lyric HCM enterprise wins. Management called out the largest enterprise wins in ADP history this quarter. If that trajectory continues, it reopens the large enterprise market that Workday has dominated. Enterprise HCM deals carry multi-year durations and generate implementation, support, and expansion revenue.
Fourth is ADP Assist monetization. 100,000 clients using the AI platform is a distribution win. Converting that to a paid premium tier is the next earnings catalyst.
Fifth is embedded payroll expansion. ADP is pushing into third-party software ecosystems as the payroll engine behind other HR platforms, expanding the total addressable market quietly. Each embedded partnership converts a competitive threat into a revenue-sharing channel with zero additional sales capacity required.
And sixth is capital returns. Dividend aristocrat status plus buybacks, while the share count shrinks, is a multi-year compounding mechanism that does not depend on the macro cycle.
Now the risks, because no thesis is bulletproof. Risk 1 is the labor market. 0, pays per control growth could persist or even turn negative if tariff-driven uncertainty deepens. Each quarter hiring stays flat removes a tailwind. The market may already be pricing in for the back half.
Risk 2 is interest rate compression. If the Fed cuts aggressively, that $404 million in client funds interest shrinks fast. The tailwind reverses into a headwind.
Risk 3 is competition intensifying. Workday is pushing down market, Paychex acquired Paycom for mid-market, and Rippling with Gusto are disrupting the small business segment. The pressure is most acute in the 50 to 500 employee range, a historically high-margin zone, where Rippling's bundled model is gaining traction.
Risk 4 is execution on Lyric HCM. New enterprise platforms carry implementation risk, and a high-profile migration failure could dent the retention rate that is the whole foundation.
Risk 5 is valuation ceiling. At 17 times forward earnings, the multiple is not demanding, but it is also not cheap enough to absorb a guidance miss without re-rating. A guidance cut would likely send the stock back toward the year-to-date lows within days.
And risk 6 is the retention guidance. ES retention was guided down 10 to 30 basis points for the full year, despite this record Q3. Small moves, but the trajectory matters.
Let's look at the competitive landscape. ADP sits at the top of the human capital management pyramid, with rivals including WDAY, PAYC, and PAYX, each attacking different segments.
Workday dominates enterprise HCM and financial software. Higher growth, much higher multiple, but smaller installed base and zero float income economics that ADP captures every quarter. Workday trades above 40 times forward earnings, making ADP's 17 times multiple a structural value advantage for investors who weight earnings quality alongside growth.
Paycom plays mid-market with a single database model and employee-driven payroll. Strong product, but recently faced its own growth deceleration and customer concentration risk.
Paychex is the closest direct comp on margin profile and float dynamics. They just bulked up by acquiring Paycom, pushing harder into mid-market where ADP and Lyric HCM now compete. Paychex has historically been one of the most disciplined capital allocators in the space, and this acquisition is the boldest strategic bet they have made in over a decade.
The newer disruptors, Rippling, Gusto, and Deal, take small business seats with modern user experience. They rarely win the enterprise accounts, where ADP has the deepest compliance moats.
ADP's true edge is scale and data. 1 million clients, $48 billion in float, compliance expertise across 50 states and globally. That network effect is genuinely irreplicable. Every regulatory change ADP absorbs for one client is absorbed once and then propagated across the entire client base, making the compliance moat self-reinforcing over time.
Putting it together, ADP delivered a clean beat and raise, expanded margins, and reaffirmed why investors pay a premium for this defensive compounder. The franchise is demonstrably intact, and management showed they can beat and raise in a difficult labor market.
The labor market is the swing factor. At 17 times forward with 30% target upside and a 3% yield, this is a quality compounder on sale. Watch pays per control as the single most important data point between now and the Q4 fiscal print.
Charged alpha is for informational and entertainment purposes only. Nothing on this show is financial advice. We are not financial advisors. All investing involves risk, including the possible loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a licensed professional before making any investment decisions. Charged alpha.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.